All right, let's get started. Finish up operational risk and then get into some of the interesting challenges to traditional risk management. I got an email from Doug Hubbard. He's got a new class. Looks really interesting, but boy, is it expensive. It's like $1,500. I took one of his classes as $500, and it was a good class, but it was a $500 class. So I wish we could get his classes. We're going to watch one of his videos, which is free, him speaking at a conference where he covers this stuff pretty well. All right, so operational risk measurement's really difficult. It encapsulates everything, including just reputational risk. It's really hard to measure. One thing you can look at is close calls. I'm a big believer in close calls. So I ride my bike every day, and anytime I have a close call, I assess it, think about what just happened, so that, you know, I'll change my route. If someone almost hits me, like this one guy stopped, he's like, oh, he's waiting for me. So I go, he wasn't waiting for me, he was on his phone. So he just floors it and just slammed the brakes, almost hit me. So now I don't even, if there's a car, I go behind them, and no matter what. They get mad at me, right? Because they're, hey, I'm gonna help this biker out. And I go around them and I get really mad because I didn't let them. I'm like, I'd rather not get hit by a car. But any close call like that, I had a bunch of bad falls one year, and I could tell it was because I was always doing this, so I just stopped doing that. So close calls are a good one. If you think about the Aviation Administration, FAA, I mean, they don't just look at wrecks, do they? They look at any close calls. It's really impressive. I was trying to find a speaker from them. I can't figure out how to contact them. But I mean, it's pretty amazing every time there's any incident in the air. You know, Boeing, obviously lately, you know, they shut them down. They can't figure out why something happened. If you got a contact, I'd love to talk to him, because we're going to talk about Taleb. He gives the FFA as an example of good risk management in opposition to finance, which is really bad risk management. So, but they're really good on the close calls. Just because you didn't have a loss doesn't mean you can't learn something from that situation. Process is more important than past performance, because we're talking about very low frequency events. You have to have a good process in place, because you're talking about stuff that may have never happened before. So these extreme tail events, you've got to have a good process in place. You know, you think about 9/11, which was before most of y'all's time. But even with 9/11, you know, you think about the process. Should we lock the cabin doors? If someone had talked about that in 2 years before, airlines would have complained, that's going to be expensive. No one would have thought about it. If he had done that, what kind of credit would he have gotten in 2001? If he'd recommend locking the cabin doors, he would have died, you know, no accolades at all, but he would have saved a lot. But then what happened after they locked cabin doors? A pilot runs a plane into the mountains and kills himself in the hope. Why? Because the other pilot was locked out of the cabin. So now they're learning, you know, so you gotta think everything, right? Every possible combinations, you gotta be pretty morbid in your thought process. So what could happen? What could go wrong? Could a pilot just go wild and want to bring down a plane? You would think he wouldn't want to take his own life, but that situation happens. So the FAA learns from every situation, which means planes automatically get safer over time. Why does Taleb say airlines get safer over time, where finance gets more risky over time? So we'll have to talk about his process there. And how do you mitigate it? Good procedures. They got to be tested, constantly monitored. Here's my approach. I'd use this at UTSA. You should try this. I would sit down and figure out, how can I destroy this company? What could I do to bring this whole thing down? Because I shouldn't be able to bring down an entire company with just myself. So UTSA gave me the ability to do derivatives. Their process was, oh, it's Ron, he can do them. That was their entire process. They didn't say, well, maybe we should constrain him in some way. So they gave me the power to destroy UTSA. I was going to tell the CFO that, but before I told him, I put a process in place that control myself and make it so that if I made a bad trade, someone would catch it. Then I told the CFO, so you realize you gave me the ability to do multi-billion-dollar trades that could have been disastrous for the company. So I set up the new process. One day I did a trade and the new process didn't send out his email. So I called poor Silas, says, where's your email? So I'm really busy today. No, you got to do it every single day. Poor kid, but yeah, I mean, this is pretty critical. I just did a trade. You need to make sure it was in compliance, that it wasn't some wild trade. What's the lowest level person that can bring a firm down? Who was the person at Societal Generale? Wasn't he a pretty low ranking person? And he caused that bank massive losses. Why? He didn't gain anything from it. He was just mad. So he decided to do major damage. How does a company defend itself from that? You got to make sure one person can't do something massive. We're not going to talk about Nick Leeson. I don't know if y'all have heard of him. We may talk a little bit about him. Are y'all aware of him? That's kind of really before your time. Oh, there he is now, man. He's getting, I don't know if that's the same guy. He's getting up there in age, if it is. But he destroyed the oldest bank, the Queen's Bank in England. One person. Should one person be able to bring an entire entity down? You would say probably not. Even the CEO. Should the CEO be able to destroy an entire firm? You think be some controls in place. Who's the guy from Bitcoin? The initial guy, the guy that just got 25 years.
Oh, Sam.
Yeah, I mean, that's one person. He brought his own firm down, so I guess that's okay. But
it was the chick.
Huh?
Most part, not him.
Who did?
It was Carolyn Elson.
Yeah, I mean, there's some, when you have a founder, you know, obviously a founder can do major damage if they're the entire firm. But we talked about you know, the importance of extremes. Not only do you run extreme scenarios, but you go to management with extreme scenario. You need them thinking. So we're going to talk the case, the German firm, the oil trading firm. That was their problem. They didn't go through extremes. They didn't tell management extremes. And then when something happened, the board just freaked out and just did the worst possible thing. This is pretty difficult because I did this a lot, but you know, I'm meeting with people that they don't care about finance. They're the head of HR, they're head of whatever, marketing, communications. So yeah, I can meet with them once a quarter, but they're going to forget what I said 2 days later because they've got a lot busier, more important things to deal with. You know, it's like, yeah, Ron, just do your job. Don't worry us. But then when something blows up, they forget, yeah, I presented all that to you. So, but you do your best, remind them, hey, if this happens, you're going to notice this. So be reminded of the downsides so that when they happen, you have a plan, you know what you're doing. People don't just freak out, fire the board, someone comes in, they shut everything down at the worst possible time. Y'all probably have remembered, well, I don't know, y'all may not have had this. I was an accounting major, but accounting controls, internal controls, y'all have any of that? Separation of duties, those type of things. So internal controls are focused on frequency and severity both. Frequency, you're trying to keep something from happening. Severity, you're trying to make sure when it happens, you reduce the loss. You want to make sure the right people are authorizing trades. So when I went over head of equities, they gave me my compliance manual. It was like that thick. And Stephanie comes over here, okay, here's your compliance manual. She's like, I'm not reading that. Fortunately, she was really good at her job. So if I got close, she came over and warned me. But most of the controls was me to sign something. So if you're sitting at your desk and you're signing stuff all day long, are you going to really look at it? So, you know, that's just because I signed something. So there's one thing I was signing. I was like, Stephanie, what am I signing? Because most of these pages have nothing to do with me. I don't have any control over that. And she said, well, page 17, that's yours. So I guess how I started signing it. Ronald Sweet for page 17 only. That's why I signed it, because I didn't have any control over those other pages. So, and they took it because my signature was on it. They didn't know that the other 16 pages were completely unaccounted for. But who's approved to do things? How do you know that they approved it? There are times we'll be in the meeting with the CEO, we need to do a trade. So I'll text Michael, do the trade. He'll do the trade. He's not supposed to do it without my signature, but guess what? I'd sign when I get back. Is that okay? Well, the market closes at 3. We're stuck in a meeting. We need to do the trade. Is that okay? Well, Stephanie never caught me on that one, so I guess I'm okay. But, you know, you get around procedures, but what if that had blown up and I come back, hey, I never signed that, then I could have, I could have thrown Michael on the bus. I wouldn't have done that, but I could have if I wanted to. Documentation. Today it's probably more digital, more electronic, but yeah, you have these massive files of stuff that shows who did what. Reconciliation's really, really important. Making sure, every transaction's been accounted for. The internal audit's going to help you with that, but you got to make sure you know what you're doing. Security of assets, security of access. My church got a ransomware 2 years ago, lost everything. And our bookkeeper, her husband was the head of security at a major investment firm. I was like, how could you should have been, I just assumed she was taking everything home on a disk every day because that's what she says she was doing, but they weren't actually doing that. And we lost everything, had to recreate it from scratch. Ransomware is pretty scary, isn't it? I don't know if any of y'all gotten attacked by that. And what ransom did they want? They didn't want any. They're just attacking for the fun of it. They didn't ask for anything. Just destroyed everything we had. We had to start over from scratch. And then separation of duties as much as you can. The people who are reconciling are not also doing transactions, don't have access to check stock, those kind of things. Sometimes it's hard to do separation of duties if you only have one person in a job. So small entities, you just got to trust the person. I've convinced our bookkeeper, the bank recon is the most important thing because that's the one piece of data we get from an outside source. And so I try to get the finance committee to say, okay, I see what the bank says we have. I see what we say we have. I think that's important with smaller entities. These small entities, they get ripped off by some bookkeeper's been there for years and he or she's taking $5,000 a year. And after several years, they've stolen $300,000 and no one knows why, because they're the only person doing the transactions. So a good book on this is Glenn Holton. He has a website. I think I gave you a link to his website somewhere or early in the semester. This one right here. I don't know what he's doing today because he's got to be getting up there in age. But good website. But he's written some great article. I love this article, Defining Risk. It was one of my first ones that I read of him. I really, really like it. It's free on his website. We used to do an article every week in my staff meetings, and my staff hated this article. So you might not like it, but I loved it. But it's a scary article. You notice his problem in his papers?
Not enough white space.
Yeah, too much white space, right? These narrower margins. But anyway, his conclusion, this is a guy who makes money on risk management. His last conclusion, so he's just spent the last several paragraphs saying it's impossible to measure risk. This is a guy who does risk management. What's his last statement? It is meanly to ask if risk metrics capture risk, because he's already said they don't. The question is it even useful? And where's his answer? Oops. So he ends his paper almost saying everything we're doing is kind of a waste of time. I don't think that's what he's saying, but he's kind of pushing that idea. Why is measuring risk so difficult? Because we tend to only measure the risk we perceive. How many of you are measuring risk you don't perceive? Anyone in here? It's kind of tough to do, isn't it? And he's saying those are actually the most important risk. Why do we measure the ones we perceive? Because we have math behind it. We have, the stuff we've already figured out. It's the stuff we haven't figured out that we should be measuring, but we don't. But is what we're doing even useful? So Doug Hubbard's going to have quite a bit of discussion on that. If I can get down to page 40 again. So he has this article called Enterprise Risk Management. I won't go through the whole thing, but it's almost laughable at the beginning of it because he's asking, why did these massive losses happen? And when you look at them, they're really small losses compared to what happened in 2008. But Orange County, we may talk about Orange County later. Barings Bank, we just talked about that one, Nick Gleason. Dawei Bank, Sumitomo Bank, look at these small numbers. And these are numbers that Merrill Lynch lost like in 7 minutes in 2008. I mean, these are just puny losses. But he's asking, why are the losses getting bigger and bigger and bigger over time? And here's his conclusion. So we've concentrated a lot more power in fewer people. And why is that? It's because of derivatives. Derivatives are wonderful because you can do a lot with very little. Derivatives are terrible because you can do a lot with very, very little. So, I talked about that swap I did, cost of zero and it's worth 500 million. It could have been cost of zero and it was down 500 million. That's a lot of leverage that no one notices because there's nothing on the financial statement when you open the transaction. So you got the leverage of derivative instruments. And he argues people aren't more wicked today. We just have given them far more power today. Why doesn't management do something? Because management tends to be the kind of people who never admit ignorance. So it's pretty effective. If you talk to someone with something really complex, but talk in a way that they should understand it, right? You use terms like, yeah, you get this, right? What are they going to say? Say, oh, yeah, I get that. And they shake their head like this and go, I have no clue what he's saying. Fortunately, we had a CEO at UTSA that he had no problem saying, I don't know what you're talking about. So he would stop us. One thing he did was really effective. You might try this is after a complicated presentation, he would go around the room and say, okay, Bob, what do you think? Sally, what do you think? And the people who are sitting there not saying anything. Suddenly they start talking. It's like, yeah, I'm not really sure what he's saying. And for some reason, and then the whole meeting shuts down and say, we're not going to do this now. So regulators, rating agencies, they're demanding better tools, but they tend to focus really big on the last thing that just happened. They don't focus on the next thing that could happen. And ultimately, we talked about this when we did the movie The Duel. In a crisis, survival is about the only thing that matters. You just got to make sure you didn't go so far that you can't recover. So Helton says there's three elements to enterprise risk management. There's the culture. If I were interviewing for jobs, they ask you, do you have any questions? I would probably ask a risk culture question. Say, I want to work in a firm that adds value. And when we see something not going right, we see a risk, we can raise it and management will listen to us no matter where we are in the organization. I would ask those kind of questions. Behavior that reduces organizational risk. So you reduce organizational risk by reducing personal risk. If you have people fearing losing their job because they're going to raise an issue, that's bad culture. You got to be able to rock the boat, ask questions, challenge the establishment. So culture says what behavior is condoned, what behavior is shunned. If you have to take great personal risk to save the organization, you say, forget it. Maybe it won't happen. Just forget about it. I'm not going to put my neck out there for a risk I don't get any compensation for. So individuals making decisions, not committees, a lot of questioning, and people are willing to admit ignorance. That's the kind of risk culture you have. So I would want to know what firm you're working for, what kind of culture they have comes to risk. If your boss said, don't bring that up, that's gonna make the CEO upset. That's not a good risk culture. So USA was interesting because I was ready to retire. So I was just like, I'd tell the CEO everything and he would scream at me and he never fired me. I even had vice presidents calling me, well, Ron, why hasn't he fired you yet? It's like, he's not screaming at me. He's screaming at the bad news I just gave him. The people he fired were the people who didn't tell him the bad news. So, and I don't know about their current CEO. Wayne's a pretty sharp guy. But I don't think Wayne's the kill the messenger kind of person. Davis, he didn't kill the messenger, but you thought he was. He looked like he was, but he was just mad at a situation. And so it's like, just tell him. I didn't care because, I had no family, no kids. It was like, fire me. Give me a severance. I'd be happy with the severance. But he was actually he was mad because something wasn't going right. He wasn't mad because I told him. So it was kind of a mix of a good versus bad risk culture. Procedures are important. I think firms have so many procedures that they just get ignored because it's just they're such massive institutions. So procedures work when you have a positive risk culture, or it actually encourages a better risk culture, because if someone's violating a procedure, it gives you the ability to raise the issue without personal risk. Because now you don't have to say, hey, I think Bob's making a mistake. Now you say, I think Bob is violating the policy. That's a lot more powerful statement to say. we changed our policies on the investment side. It went from a 2-page investment policy to like 50 pages. And the investment company says, we don't care, we're gonna keep doing what we're doing. And so we go to Bob Davis. He's like, yeah, we're in violation on this, this, and this, and this. And he's like, why is that? He says, well, they think they can still do what they're going to do. I mean, you should have seen, you think he got mad on that one? He was pretty irate on that one. It's like, no, this is the procedures. They will do this. So no procedures makes you have to take more personal risk. It reduces uncertainty, so it promotes action. You somehow have to monitor these, make sure they're up to date, because the world has changed so radically now. And don't start with the regulators and rating agencies because they don't have the right objective, the right incentive for risk management. Their goal is that nothing happens under their watch. They don't care about you being optimal and profitable. They just want you not to lose anything. You're actually trying to make money, so you got to take some risk intentionally, so you can't start with them. And the last thing is technology. Make sure you're not buying technology because it's cool. Make sure you're buying technology because it's going to accomplish something. So the hardest part I discovered was getting the data you need. That's probably getting better now, but where is the data? That's why I say learn Capital IQ, learn Bloomberg, learn FactSet, learn where is the data for your firm. Your firm probably uses Oracle, I would guess. Maybe what's the new one now? Salesforce. But I mean, what do y'all use? You using Oracle? ServiceNow. Is that owned by Oracle?
I think it will.
Okay. Yeah, for us it was PeopleSoft, and that got bought by Oracle. And so they're probably getting pretty good, right? You can get data pretty easily in the manual, I can imagine. Is it built through the software, or you have to write a program to get data?
Built through the software. Even Microsoft now is using
All right. Are you using Python every day?
I use Python.
Yeah. So yeah, where's the data? How do you get it? What do you do with it? When you get it, that's gonna be pretty important. So that world is definitely changing, especially with AI. Getting information on a consistent basis. You got to be prospective, not just historical. And then we talked earlier about the garbage in, gospel out. We talked last night in my P&C class, the importance of getting data. We had an actuary 2 years out of UTSA. A lot of data in his job, obviously, massive database. And if he messes up, the whole company goes under because he's pricing products, or if he misprices them, they lose a lot of money. So the data is pretty important, and trends, everything's changing. Is the trend changing, or was that because of COVID? That was one thing he was saying, AI trying to interpret COVID. Is COVID doesn't know COVID. I mean, AI doesn't know COVID is temporary, but it's going to interpret it as, hey, everything's changed. And, a human's going to say, well, wait, this is going to pass. We can't overinterpret this data. So it's getting tough. So there's some Glenn Holton. I do recommend, I haven't read his article in a while. He gets a little philosophical in here. That's maybe why my department didn't like it. And the Harry Markowitz doesn't even fit in this article. I don't even know why he threw that in there, but I liked it. It's a very old article, my word. I don't know. It's interesting. It's the first thing on his website, given that he wrote it many years ago. So let's take an example of some operating losses. So British Petroleum, back when you were in elementary school, they had a massive oil spill in the Gulf. And so they came out, I found this article. They said that they had learned from their mistakes. And they said, you can trust us better going forward. So here, what did they learn? It was a perfect storm of aging infrastructure. They were cutting costs and ignoring risk. They were focused on form, not the substance. I think that's what AIG was doing. AIG, had this massive risk management function. They're just kind of going through the motions. They ignored those close calls, those warning signs, too focused on profits. They said it wasn't an overarching problem. They can just fix these things and be fine. All right. Oh, but then I noticed the date of the article, and it was written before the oil spill about all their previous risk before that oil spill. So yeah, I'm reading this. I actually reading this article thinking, oh man, they're talking about the oil spill. And then notice it was written 4 years before the oil spill because they had killed a lot of people in India with a major disaster, it's all kinds of stuff that they had done. So did they really learn from their mistakes? Doesn't sound like it. See if you can figure out who this person is. This person said this in September 2008. There's some pretty interesting words here. It is hard for us, without being flippant, to see even a scenario within any realm of reason that would see us losing $1 in any of those transactions. Sounds pretty low risk, doesn't it? Got great confidence. We're sitting on a great balance sheet, strong investment portfolio, and a global trading platform where we can take advantage of the market in a variety of places. Any guesses who said this? No, it's a little late for Lehman Brothers. He did say something like that on the Friday, but he didn't quite say it that strongly. Now, Lehman Brothers, thinking about Lehman Brothers and all the investment banks before today, their whole business model was high leverage with a lot of short-term debts. So they're constantly going back to the market. That model works great unless there's a crisis. And so when you have a crisis, no one's going to lend to Lehman Brothers. And that's essentially what this Lehman Brothers guy was saying. Hey, just give us money and we'll get through this crisis. And the market's like, it's what we talk about with liquidity. We don't know if your problem is a liquidity problem or a solvency problem, but we're not going to give you money. So that if it's a liquidity problem, you're going to be insolvent anyway. If it's an insolvency problem, we're not going to help you. But no, it wasn't Lehman, but who else could you guess? AIG, yeah. And the head of the founding member of the department that brought them down. Do you want your CEO saying we can't possibly lose $1 in those transactions? That's obviously not true. I remember I met the CFO of Texas Commerce Bank, which you've never heard of. But he was bragging how they've never had a quarterly earnings that was lower than the previous quarter. When management is saying, hey, every quarter has to be higher than the previous quarter, what are you incentivizing? A lot of bad accounting, a lot of lying on the books. You don't want that. No one should say we can't ever lose money here, because then you're gonna try to fix the books. This is a great article as well. I won't get too much into it, but he talks about the 6 rules of effective forecasting. Forecasting is a big part of risk management because you're making decisions about the future. And forecasting is not what you think the future is going to be. It's what you think the distribution of the future is going to be. We'll talk about that when we talk about Amy Duke. But so he talks about the cone of uncertainty, which is essentially your distribution. And also that Kahneman has a good article in here. So I might get back to this article. We have time. I think I'm pretty sure I'll put it out there on Canvas. If not, I'll add it. But he said, well, let's see if it's out there, because there's a few things he said I thought were really, really, really interesting. I'll find next class. I'll talk because I know I have it out there somewhere. But he says the purpose of forecasting is not to predict the future. The purpose of forecasting is to document your ignorance. How uncertain are you? That's the purpose of forecast, to see how wide is that distribution. And then your goal in spending money is to bring the distribution in. If you're going to spend money, you want to get more information. And Doug Hubbard's going to say the same thing. Kahneman, he talks about biases a lot. And he talks about how do you overcome biases, and he has a whole article on that. So I might show you some of these next class if we have time. We're getting a little bit behind, but really good articles. We're going to talk more about Kahneman, definitely. And then some quotes here. These are Hubbard. Why leave something out? Because it is uncertain. The whole point of Monte Carlo model building is to deal with uncertainties. If you leave out a variable because it's uncertainty, makes about as much sense as not drinking because you're thirsty. Some address this with pre-mortem. I love pre-mortem ideas. So have y'all done that before? So you've heard of post-mortem. I was asking my doctor friends, do y'all use the phrase post-mortem? So what's post-mortem? Someone's been harmed on the operating table. Now going to sit down and see what went wrong. Right, we're supposed to take their left leg. We actually took the right leg. Has that ever happened before? That's happened, right? They took the wrong body part out because something got mixed up. You know, every time I'm at the doctor now, they're looking at that little wristband. Is this, what's your date of birth? You know, double checking. Well, what's a pre-mortem? So pre-mortem is you say, okay, we just made this decision. We're going to execute tomorrow. Let's sit here and say we're here a year from now and everything went wrong. Let's talk about what went wrong. It makes you start thinking about, okay, we're going to execute this trade. A year from now, we're going to really wish we hadn't. Talk to me what happened. Oh, the Fed did this and we're expecting this or whatever. So that's a pre-mortem. It makes you, and we're going to see this with Amy Duke, it makes you think about scenarios you hadn't thought about before. Do y'all use prediction markets? There's several pretty good ones out there. I forget the name of them. I'll see one when it comes up. Not that one. Here it is, predicted. Have y'all seen that? Have y'all looked at that? So, Trump is up on the GOP nomination. Biden's up on the Democratic nomination. I don't know where the 2 cents is. Would you bet on against out of those? You got an 80-year-old person, 79-year-old person with I don't know how many trials going on. There is a scenario where one of those two is going to drop out, isn't there? I mean, even a 50-year-old, there's something that could happen. But 2 cents, does that seem about right? Is there I don't know what 2 cents out of 92 is, but a 2% chance that Trump doesn't get the nomination. It's feasible. Why is Biden higher? They got Newsom in there. Is it because of his age? And how good are these predicted markets? If Biden wins the nomination and goes on, does that mean this 5 cent was wrong? No, it just means they thought something had a 5% chance that didn't happen. That seems like a pretty logical solution. I don't know what else they're predicting out here. Did they have the March Madness in here? So prediction markets, pretty powerful things. What we discovered is when people have skin in the game, when they have money on the game, they're better forecasters. When they don't, so even some firms, they've even tried going out to their employees and quizzing them. The individuals are terrible, but the group is pretty good. So when you bring the group together with these kind of markets, you end up with a fairly decent amount of information to build a Monte Carlo a distribution. Like put money on the line. I don't know if can you actually bet money in the predicted? Anybody use Congress? Who's going to win Congress? That one's pretty up in the air, isn't it? The Senate and the House are both. Some people are talking Trump wins president but loses both houses. That would be the first time in history. But this is probably the closest we are to that. What's the chances Biden wins and wins both houses? You know, those kind of things you'd look at. Does the market care which of those happen? We may not even be sure. Someone you might say, well, if that happens, the market's going to do that, and then it does the exact opposite. These are interesting scenarios to try to think through. I don't know what happens when you sign up. What do you get? Do you have to pay money to them? What are leaderboards? Wow, this guy's pretty good. I don't know what that means, but maybe we should add that to the investment society. We should predict it instead of markets. What's the chance China? I would want to see what's the chance China is going to attack Taiwan in the next 3 years. That would be an interesting scenario to do. What's the chances oil prices go back above $100? What's the chance the S&P falls more than 50%? You know, all these are interesting scenarios. And this gives you some insight. Here's the market. Harris being the 47th president. What is Biden? Is he 45? He's 46. They're talking about, is he still 46 if he wins?
Yeah, that's all.
We don't count again. All right, so they're talking about her being president after him.
Yeah, the only time it would change is if you like lost or you won, then you lost.
Oh, so Trump would be 46 if he won. Who's going to win this Arizona Senate race? Yeah, boy, the Republicans kind of got a little bit behind on that one. Yeah, I mean, there's some interesting predictions here. You need good statistics in order to prioritize projects. And probably my best example of this is this guy here, William Lomberg. I read his book. I thought it was exceptional. So he's saying, what are the projects the world should be, what should the United Nations be focusing on right now? And he goes through and he talks about the cost versus the benefit. He talks about the risk, what if we're wrong. One of his number one things, which I really agree with him, is tuberculosis. We could do major good by finding some way to cure and treat tuberculosis, because that kills a lot of people every year. And everybody thinks malaria, but tuberculosis is a major, major illness. He had an article on education. We started this educational thing in Costa Rica in our FARSA care program. And I immediately went to the head of the people down there and say, hey, we need to try this. It's pretty powerful stuff. So I recommend, this is not his book. This is his TED Talk, probably the least popular TED Talk ever in the history of TED Talks. As he was saying, yeah, global warming is happening. It's going to be bad, but there's actually better places where you can spend the money than on global warming. And the whole place is like, oh, no, you can't say that. But, you know, he's an economist. He's like, here's what the numbers say. If you don't agree with the numbers, then tell me the right numbers. You know, he's just saying, so it's a different way of thinking, is what do we know, and based on what we know, what should we do, versus our biases of what we think we should do just because we've always heard that. So yeah, so what going forward are y'all worried about? So what's new? I hate how Bill Gates does the fonts. What's the major risk that's going to come up in the next 5 years no one's thinking about right now, which means you're going to have to think about it right now. I mentioned Taiwan. Is anybody talking about that? I can't spell Taiwan. How do you spell Taiwan? Too many W's. Yeah, Putin, I think. What happens if Putin gets taken out? You know, that's kind of a question. No question, Stalin coming out was a good thing. You go back and read. I'm a big Shostakovich fan. There's no question. I don't know if y'all know Shostakovich's 10th Symphony, but it was written right after Stalin died, and it's like the happiest. He writes his name in music, and his name is in that piece. He's like, I win, Stalin loses. I mean, people were really happy when he died. Would it be the same thing this time, or would another Putin take his place? Do we even know that? Have we figured that out? I think Xi the same way, though, don't you? Are y'all worried about Xi? I mean, he's kind of the new Mao Zedong. I mean, he's pretty dictatorial, pretty controlling, pretty interesting.
Israel using the leaks they stole.
I don't know.
Yeah, they have nuclear weapons.
How would they use the ones they sold? I mean, the ones they bought?
No, like they
stole.
Yeah. It's a little nice.
So I don't know if Israel's rogue, but some rogue nukes. I mean, you could think about Kim as well, right?
Yeah.
Would Kim do something? I don't know if Kim did something that would probably be the end of North Korea, probably be complete destruction, but they're right next to China. You know, there's things that are going to happen. I mean, are we talking about World War III during your lifetimes? Well, are they going to draft you guys into the military?
Follow the US currency, Brits. Brits, or the US currency.
Yeah, so currencies. Yeah, is the US dollar going to continue to be the store of value, or is it going to get this further? There's a lot of places. The one I think about is cultural and generational. I haven't seen in my life how quickly things change, so it's been interesting to me. Some of them, you know, companies are taking risks. When Nike got endorsed by, is it Kaepernick? And people say we're going to boycott them, but it ended up kind of working pretty well for them, right? Who are the boycotters? There's guys my age who haven't bought tennis shoes since high school. So he's like, Nike's like, we don't care about them. So it tended to work, but then Budweiser didn't go as well, right? So you think about these cultural things, you're stepping into that. I mean, it's how are firms going to handle this when you have 70-year-old, 60-year-old people making decisions in their workforce is a bunch of 20, 25-year-olds who have a very different view. It's pretty interesting. So that's going to be because people making the decisions are about 40 years older than you, live in a completely different world. Do you think that what they're saying behind closed doors is the same thing they're saying in public? Huh?
Congress puts a age limit on the representatives, so that's what they're talking about now.
Well, how would that impact things?
If they put an age limit, then with younger people that get younger ideas in Congress, so.
Oh, so, well, yeah, generational issues I think are huge. If I were you, I'd be really mad at my generation because we've massive deficits. I laugh on Facebook when I see people my age saying senior citizens shouldn't have to pay educational taxes, property taxes. It's like, do you realize we're like much wealthier than the younger generation? We're the people with money. Someone's got to pay these taxes. Yeah, so there's a lot going on. How's this all going to blow up? You know, the political divide is pretty radical right now. Our elections are so close, but you're seeing that overseas. You're seeing South America is like sharp left, sharp right, sharp left, sharp right, just constantly. I mean, it's just amazing. So is that different than historically, or am I just remembering things incorrectly? That's the hard thing to know. You know, I don't remember it, but who knows? One thing I will say, the 60s were pretty horrible. And y'all remember the 60s? Obviously not. Do you have, what is your thought of the 60s? You got the Civil Rights Act, a lot of protests. You got a president assassinated, his brother assassinated, Martin Luther King assassinated. I mean, I was a little kid of 5 or 6 thinking, man, this is just, we had a massive black and white TV. I just remember Johnson, LBJ, is like, man, I don't know who that guy is, but he's awfully mad and stressed out because he just looked terrible on TV. So I don't know if it's worse now than then, but it's very different. So yeah, this generational issues, where I was thinking at USAA, when the Me Too movement hit, I thought, man, things really have changed the last 40 years. Your great-grandmothers are too young. When were your great-grandmothers working? In the 50s, 60s, 70s, probably the 70s, right? So you missed out. I wish you could go back and talk to them. I don't know if you know what it was like to be a businesswoman in the 30s and 40s and 50s. It wasn't real pleasant. We used to have sitcoms where bosses were chasing their secretaries around the desk, and that was supposed to be humor. So the world has changed pretty dramatically, but I think there's people still in place that have those problems, but just haven't figured out that the world's changed. So, I mean, I tell you my grandmother's story. She was married at 16, had 4 sons by 22. Her husband worked in the Texas Capitol. He painted and did maintenance. So one day he was painting and the rope broke. He fell to his death. She had no workers' comp, no money. So she goes to her state rep and he says, I'll help you if. What do you think he said? Sexual favors. That's what he asked for. What could she do? She went to another rep. That's all he could. She had no other power. What could she do today with an iPhone? I mean, she'd be set, right? Back then, she went to another rep. He made her she was in charge of taking care of the paintings in the Capitol. And they paid her enough to survive. But that was the world back then. Has it changed much? I could tell you stories at USA that are shocking today, but back then there was just kind of normal. I'll tell you one just so you kind of see, because I do think this is important. Who your CEO is really critical when it comes to these generational issues. You can debate Bud Light either direction, but these are major decisions. But there's a guy who is going to be the next CEO of USAA. He was in training. No one liked him. He was an incredibly arrogant guy. Fortunately, Bob Harris came along and got the job instead of him, so he disappeared. But a couple years later, I was on a bike trip, and one of the women there worked for Goldman Sachs. So we were talking about her job, and she told me this story. When Goldman Sachs was bidding for business at USAA, they're at this hotel. She makes her presentation. She's probably in her early 20s. So pretty impressive how ranking she was at Goldman Sachs just a couple of years out of college. But guess what happened at 10 p.m. that night? Someone comes knocking at her door. Want to guess who that might be? It's this second highest ranked person at USA asking her to go for cocktails. Now you're a 23-year-old entry-level person who's moving up at Goldman Sachs, and you're about to win one of your biggest clients. and the guy who makes all the decisions knocking at your door, what do you say? What do you think she said? She said, no, thank you, and slammed the door, but she had a lot of guts to do that. That kind of shocked me. It shocked me more when she said, I don't really know how he knew what room I was in. And I said, yeah, that's kind of scary. Aren't you glad USA didn't hire that CEO and got Bob Harris? Bob Harris was the complete opposite, a man of just incredible integrity, but that close to having this absolute jerk. I mean, y'all think that's inappropriate, don't you? Or am I completely misinterpreting that? But I was impressed by her, how confident she was. Like, yeah, no thanks. See you later. You can get me fired tomorrow, but that's fine. I think there's a bunch of those people still in the company that are just haven't figured out the world has changed. And boy, you should be really concerned when you change CEOs. What's the ethical background of that CEO? Is he gonna or is she gonna make this firm just topple? So, but I could tell you several other stories, but I won't bore you with USA's Me Too moments. All right. Oh, we got a few more risks I forgot about. All right, purchasing power risk. Real quick, purchasing power risk, that's the risk of inflation. We already talked about how massive that one is. That's pretty important. You can handle that through value risk analysis. You can model CPI fairly well. It has very high serial correlation. So inflation is not random. It moves in cycles. So you can't just have a random CPI in 2024 and ignore what it was in 23. In fact, 3 years later, the correlation is still like 0.4, 0.5. It's still fairly high. So you'd have to model it over time, across time. Y'all know what serial correlation is, right? Things are correlated across time. So you have to take that in consideration. But you can model it. You want to look at how it hits your income, your expenses, your assets and liabilities, each of them independently, and just try to assess how would high inflation impact us. We're starting to see oil prices jumping back up. And you certain today saw, man, the markets were pretty wild today. So the 10-year treasury is getting back up to 4.5% again. Oil prices are starting to get closer to $100 again, but we're back at a 4.4 10-year treasury. And yesterday was pretty wild, like 12 basis points yesterday. So we're starting to see some inflationary issues happening, which might make the Fed have to cut back on their cuts. How do you mitigate this? Gold would be good, except for gold's more concerned with the dollar than it is with inflation. So that one's a little bit tough. I need to test this one. I've been thinking about sitting down with, I can't think of an inflationary period where oil wasn't taking off. So oil might be the better protector than gold, but I need to actually look and see if that's the case. Oil is not as closely tied to the dollar as, it's not as sensitive to the dollar as gold is, because oil is priced in dollars. Real estate, yeah, real estate can be a hedge, but also mortgage rates are tied to inflation because they rise. So, you can't have that impact, especially REITs, because REITs are high dividend paying stocks. They don't like higher interest rates, which rates are going to go up when inflation's higher. Cash can work in an inflationary period, but you can't sit in cash for 5 years waiting for inflation to hit, because it's going to kill you on the returns. What about tips? We already talked about them. They were actually down in 2022 when you needed them to be up. Why was that? Why did tips go down in 2022? There's two things that hit tips: CPI and real rates. And which of those killed tips in 2022? Real rates from negative 0.7% to positive 2%. That just crushed. So tips, yeah, they pay you CPI, but they're also very sensitive to real interest rates. And real interest rates jumped dramatically in 2022. Real return funds, we talked about those a little bit. That PIMCO fund, essentially they're trying to give you a T-bill rate plus 4% or something like that. They're trying to move with interest rates. They just haven't been all that successful. There are interest rate swaps, but there's not much volume. we looked at them at USAA and it's just like, there just wasn't enough there that you could do anything with them. So that one's pretty tough. You can buy other currencies. The problem with that in 2022, yeah, we had inflation, you buy other currencies, but the US dollar strengthened. So you would have actually lost on that bet because inflation hit the entire world. I asked my other classes, what's inflation? Well, someone's in my investment class in here. What's Turkey's inflation? Right now, anybody know? Well, it's come down since my previous class. How do you handle 65% inflation? Erdogan says cut interest rates. That's kind of the opposite of what you're supposed to do. But of course, he's trying to get reelected. Could the US have 67%, 65% inflation? Could we survive that? It would be, you could hire someone to manage your currencies if they know what's going on, but who knows how good they're going to be. Inflation is just a really, really tough one. It's hard to think of firms that actually go and solve them because inflation, it's usually just firms have really bad performance while they're working through the higher costs. But yeah, it's a very, very difficult risk. And then currency risk, closely related. Currencies change and that causes a loss because of the way they hit their revenues and expenses and assets and liabilities. Value risk is, again, another really good way to do the analysis. And how do you mitigate it? There are really good derivatives out there to help you mitigate it. You probably can't get it perfect, but you can mitigate it. One thing you have to watch out for is the economics versus the gap accounting. You might have it perfectly hedged economically, but it still hits the books really horribly because I don't know if y'all know gap accounting for currencies, but it's a mess. It's really, really messy. It's very, very difficult to get the accounting to line up with the economics. The economics is actually easier than the gap because gap accounting has all these rules about translation versus, do you do it at this point in time? You do on average over time. What do you revalue at the end of the year? So it can be tough. So this is one you may just tell management, we're hedged economically, but the way it's going to cut through gap accounting may surprise you. Just be ready. All right, so that was our last risk. So there's an exam question that essentially you pick a few of these risks and fully talk about them. We'll get into that when we get closer to the exam. So you have to pick one of the major ones, which is either interest rate risk or price risk or credit risk. I can't remember if credit risk is one of those. And then you pick two of the smaller ones and talk about them. We'll get into that as we get closer. All right, this is
like you're right before, you're talking like during the test.
no, it's you submitted before.
Oh.
All right, so now I want to get into before we do our case studies. There's 4 people who've had a pretty big impact on discussions and risk. Taleb has probably been the most popular one. I don't know how many of y'all read his books. He's got 4 of them out there, or at least he might have more. What does he say? And he's pretty critical of finance, especially in the way we measure risk and manage risk. Kahneman is all about biases. Duke is Kahneman, but practical. How do you implement Kahneman? I highly recommend Annie Duke's first book, not the second book, her first book. And Hubbard, we're going to actually watch one of his videos. So this part of the exam, I can't remember if I think I tell you pick one of these authors and discuss what they're saying. So take notes as we go so you can figure out which of these authors you like. So he wrote Black Swan. I think Fool by Randomness was actually his first book. Black Swan's the one that really took off. Anti-Fragile is what he says is his best book, but very few people read it. And The Bed of Procrustes, no one knows about, but it's out there. I don't recommend that one unless you're in the weightlifting because that's all he talks about. But I actually thought Fool by Randomness was the most useful one. He said Anti-Fragile was the most useful one. I love the concept of Anti-Fragile, but you don't need the entire book to get it. You can summarize it down pretty quickly. And then this is just a bunch of weird quotes. Why is Black Swan the most popular one? I think is pure luck. I don't think there's a really radically big difference between those 2 books. Which one have y'all read in here?
Last one.
You read Black Swan? Yeah, that's his most popular one, so it makes sense you could start with that one. So what I'm going to do is I've got it divided in his main points. So what you're going to have to do is take his main points, and then you're going to have to summarize his quotes into what is he really saying. So we're going to let his quotes make his arguments for him, and then we'll, kind of summarize it all at the end so you can see his main points. There is some overlap on some of these points, beyond a doubt. So let's start with this first one, and that's how we handle distributions. Finance over relies on the normal distribution in places where it doesn't really apply. And what he says is there's two worlds out there. And I hate these terms because I can never remember how to say them, but mediocristan and extremistan. He says mediocristan works really well with the normal distribution. So things you see in nature, things like height, the average height, those kind of things where the normal distribution will give you pretty good ideas of what's going on. Extremistan are those parts of the world where there's some tail events that are completely unpredictable by the normal curve because they're so extreme. And his argument is the normal curve is going to ignore those, but he thinks those are actually the most important things to look at. He calls them what? Black swans. He says the entire world history has been a series of a few black swans. The whole world history has been decades of absolute boredom, followed by a black swan that changed everything, and then decades of absolute boredom and repetitiveness, and then another black swan. So will y'all see a major black swan in your lifetimes? Probably 4 or 5, depending on how you define it. In my lifetime, the assassination of Kennedy seems like that would be. The Civil Rights Act would be one. Nixon would probably be one. The oil crisis in the 70s, definitely. The 87 drop would be one. I can think of those big events. There's probably about one every decade, if not 2 every decade. Events that would just not be predictable by extremistan. So we're using statistical inference, large sample sizes, but he says in extremistan, those are actually dangerous because they make us comfortable that something can happen that can't happen. So mediocristan, the distribution says there are no 40-foot tall men in the world. Would you be shocked if you saw a 40-foot tall man? Be pretty shocking, right? Probably not out there. How confident are you that there's not a 40-foot tall man? It's probably not even physically possible, is it? Nature wouldn't even allow it. Extremistan says there's no one with a net worth more than 100 million in the world. How confident are you? Would you be shocked if you saw someone with $100 million in net worth? Extremistan's, normal curve says that's impossible. How do you figure out there's someone with $100 million? How large does your sample size have to be? Until you get someone with $100 million. Until then, you don't know. Right? Because there's so few of them, but it does happen. In fact, extremistan says it's less likely to have someone with $100 million than it is to have a 40-foot tall man, according to normal curve. And we know there's probably people with $100 million just in San Antonio, right? Maybe some of you, maybe, I don't know. So we should be suspicious, doubt the data. History tells us what has happened, not what could happen. So just some quotes from Black Swan. Sometimes a lot of data can be meaningless. At other times, one single piece of information can be very meaningful. 1,000 days cannot prove you right, but one day can prove you wrong. And he gets a little silly here. He proves that O.J. Simpson could not have possibly killed his ex-wife because he said, I've seen him on TV hundreds of times and I've never seen him kill anybody. So my distribution just said there's no way he did. He proved that George W. Bush was immortal. It may have been George Bush Sr. Why? Because he's seen him 40,000 days and he's never died once. So obviously this guy is immortal. So those kind of, but he says that's exactly what we do in finance. Forget everything you heard about statistics and probability theory. I don't recommend that. But one of the most misunderstood aspects of the normal curve is its fragility and vulnerability to the estimation of tail events. So that's his big focus. So We saw this with the normal table. Those numbers barely move when you get out in the tail, and like we're talking really, really extreme events. The odds of a 20 sigma events are 1 trillion times higher than a 21 sigma event. And yet on the normal table, there's hardly any difference in the two numbers. So it means a small measurement error of the sigma will lead to a massive underestimation of the probability. We can be 1 trillion times wrong about some events. Here he talks about wealth. Here he says, what's the probability someone has more than $8 million? Whatever that number is. Do you think there's people out there with more than $8 million? Do you think that's the probability? That's that's more than the number of people on the earth. So how did he get that? Well, when you sample a lot of people, you don't find many millionaires in the numbers because they're only like 0.1% of the world population. So if you sample 500 of them, 500 people would be plenty if you're trying to figure out the heights of people. But if you're trying to figure out wealth, it just doesn't help you. So he says the probability someone with more than $16 million is impossible. There's no one out there with that much money. People will find data in which there was no jumps or extreme events and say that's proof that they can use the normal distribution. Here's his O.J. Simpson. He saw him several times not killing. The entire statistical business confused absence of proof with proofs of absence. People did not understand the elementary asymmetry involved. You need one single observation to reject the normal curve, but you need millions of observations before you can fully validate it and be confident in it. Why? Because the bell curve, this allows large deviations. The tools of extremistan do not allow long, quiet stretching. We get lulled into these, nothing happened, so nothing can happen. And actually, that's probably when they're most likely to happen. He hated correlation, similar to what we saw with some other readings. The correlation measures will likely exhibit severe instability. We saw that. It will depend on the period for which it was computed. People talk about correlation as if it's something real. Once you get the bell curve in your head, it's hard to think otherwise. Now, Annie Duke's going to say think in bets. How does she handle this extreme? You'll see how she tries to tackle it. She believes we're better off making decisions statistically than off of our gut. But we'll see. Does she make any adjustment for the fact that our statistics can give us some bad information? All right, so there's the first one. He does not like the normal curve. He thinks it leads to bad decisions. It makes us overconfident to do things that we probably shouldn't do, and then ends up costing us more. Any questions on his first one? You should still read his book, even though I'm giving you his quotes, because who knows if I missed some of the best quotes. Rob, you can tell me if I left any out. But did you highlight what you're reading? Underline? That's the downside with me listening to Audible books, is I haven't figured out how to take notes. The second problem is he hates finance because of the way we get paid. He thinks we get a lot of bonuses for pure random luck. And he thinks we reward people because it worked out, even though it was entirely due to luck, and that incentivizes us to take more risk. So we perform well, often entirely due to luck, but force our clients to pay for that luck. Now this is kind of an extreme. He says we're playing Russian roulette, but we're pointing the gun at our client's head. And every time we pull the trigger, he says, see, it worked, pay us more money. And what he's saying is every time you pull a bullet and pull the trigger, what's happening to the risk of your client? It's increasing. And he's saying that's the game we play in finance. We're playing Russian roulette with our clients' money, charging them huge fees anytime we pull the trigger and no bullet comes out. Of course, each time we pull the trigger, the probability of the next time is higher. Jack Bogle said, we have moved, I love this quote, we've moved from an ownership society to an agency society. We're managing other people's money. So our view of risk is what? You remember from, was it exam one? What was that paper we did? So what was the 4 risk?
Pure risk.
Pure risk.
Anti-selection risk.
It does, well, no, you're mixing the two, but asset risk, ALM risk, what was the fourth one? Career risk. What risk does the agent manage? The client's risk or their own personal career risk? So that's the agency society. We stop managing money and become marketers of random outcomes. That's a pretty horrible quote. I believe we add value in finance through risk management, not through alpha. So at USA and in my career, I was focused on risk management, not on adding alpha, because I know alpha, beating markets, is almost entirely a random event. And I know James Simon's out there and all that. I bet he was pretty focused on risk as well. But you add value in finance by managing risk well, not by trying to beat markets, because it's really tough to beat markets. And how do you beat markets? You beat markets by taking risk. So if you're wrong, it's even worse. A successful person is going to kind of convince you that they had skill, right? You can go to Vegas and people say, "Oh, this is my trick," or winning the roulette wheel. Is there a trick to winning roulette? I've never played roulette. I was in Vegas once, and it seemed really boring to me. So I got on my bike and went bike riding. I didn't, I don't like cigarette smoke partly, but I mean, these people, have y'all been to Vegas? These people look really depressed, don't they? It's like, man, this is a horrible several hours, and they've been there like all night long. It's like, man, this just looks horrible. But if they win, they're gonna say, "Hey, yeah, I figured it out. This is what you got to do." It's like, you hold your tongue like this or whatever. But why? Because we like to think we're skilled. Explain that the odds against such a streak are 1 in several million. You either have to believe in some intervention or play, and it's in play, or accept the skills. The reference point argument is this: do not compute the odds from the winners. Do it from the cohorts. So he criticizes these books of what do successful CEOs do, and he has he's seen those books and he lists what successful CEOs do. What's the problem with that book? Well, that's the exact same thing unsuccessful CEOs do, right? Successful and unsuccessful CEOs do the exact same things. But what's the problem with a book about successful CEOs? You pick the winners out. The loser were doing the same things. So you have to start with the entire group of CEOs and see what the successful ones are doing. That's not how they write the book. They go find the successful ones. They try to find the leads there. No, you got to look at all of them and see what's the true difference here. At any point, the richest traders are also often the worst traders. This I would call the cross-sectional problem. At a given time, there's most successful traders are likely to be those that are best fit for that particular cycle. That's not true of dentists and pianists. If someone sat down at the piano and played a Beethoven sonata perfectly, would you say, I think that was just pure luck. I think they just happened to hit the right keys. Would you believe that? But could that happen in finance? Could someone trade and buy the perfect stocks and buy NVIDIA right at the right time? You say, oh, it's got to be skill. But that's not true. The pianist, yeah, I mean, it'd be tough to sit down and play Beethoven perfectly. But a trader, yeah, it's possible. Poker player, could someone, a novice, come in and win a poker game? Absolutely. Could a novice come in and beat a master in chess? Impossible, right? Very, very different types of thought process. So he says with dentists, you hope that's not true with dentists. Pianists, not true. Those professions are immune to randomness. Our profession is overwhelmed with randomness, and we reward randomness. We pay bonuses to randomness because we can't tell the difference between skill and randomness. And that's in the Fooled by Randomness book. So you can see why he came up with that title of the book. And sorry about these page numbers, because you might buy the book that's published a little bit differently. So no telling. So, write an algorithm. If you find this on page 83, then multiply by 1.032 or something, and you'll find the page. So he talks about this, you start with 10,000 and they have a 50-50 chance of winning. And you keep doing that. After a while, you have 313 that have won 5 years in a row. What are those 313 doing? They're on CNN, they're on Money Magazine, they're doing the tour. And what are people asking you? What did you do that's different from everybody else? And they're so brilliant, they have these great ideas. But randomness says just randomly you would expect that many winners, just by pure random play. So the fact that you have 313 that won 5 years in a row doesn't prove that they have skill. That's exactly what you expect. I think I told some of my classes a story, but I did this for my boss. He asked me, just go find those managers that are consistently about 25. And so I went out, looked at 33,000 managers. I found the ones that were consistently top 25. I found 11 of them. My boss says, let's interview those 11. I said, well, if it had been random, I should have found 13, but I found 11. So it was less, those 11 are more likely to be pure random noise than they are to be actually skilled. So they're going to brag about their great style, how incisive they were. His biographer will draw on the wonderful role models provided by his parents. Should he stop outperforming? What are they going to say? Well, he's lost his tack. When you think about Bill Miller, not that barbecue guy, but the Legg Mason Bill Miller, he beat the S&P 15 years in a row, which is absolutely phenomenal. He's a value manager, and he beat the S&P in 98, 99, which is incredible because he was buying tech stocks even as a value manager. And then he sold out of them before 2000. So, I mean, it's pretty amazing that he won in 98, 99, 2000. Incredible. And then he had 3 horrible years. Was he skilled for 15 years and then he got stupid? Was he lucky for 15 years, got unlucky? What are the combinations that it could be? I think he's a pretty smart guy. He's got some podcasts out there where he's really, really interesting to listen to. It sounds like he does have some insights on markets that should give him a little bit of edge. But I do think a lot of that 15 years was there was a lot of luck in those 15 years that he just kind of happened to do a trade right at the right time. But who knows? So eventually you're going to underperform. That's what we're talking about James Simons. We don't have James Simons' numbers. We think they're really, really good, but we don't know. Wouldn't you love to see his detailed monthly numbers and really scrutinize what bets he's taking, do a style analysis on him and see what bet he's taking? But we don't know. So that's kind of his advantage, is he may be horrible and we just have so idolized him that we just don't know how horrible he's done the last few years. Right. There seems to be no such thing as a foolish decision as long as it creates a profit. The link between skill of CEO and the results of the company are tenuous. There are so many companies doing all kinds of things that someone's bound to make the right decision. They're skilled at getting promoted. These are people mostly trained at using PowerPoint. Shareholders are the ones who are fooled by the randomness. I mean, a good example is the exec from Apple. He does great things for Apple, gets them all lined up marketing wise. So he goes to JCPenney, and what does he do? Completely destroys that company. Is it that he was skilled and unskilled, or skilled at Apple, but wrong idea for JC? Who knows? But they just assume he was skilled at Apple, was going to work at JCPenney, and it didn't. All right, I can tell you are leaving noises. So we'll do some more tailored here. I will give you the link to the Doug Hubbard this weekend, and you can watch that and get through that. Okay, we'll stop it there. Okay, a few things to get us ready for the rest of the semester. We've got about a month left, so make sure you're ready. On the exam, I don't know when our exams is, but this is the guide from last time. I just want to let you know, one question you could probably start working on, because we finished all the risk, is using that define, measure, mitigate. Pick one of the main risk, interest rate risk, price risk, or credit risk, and 2 of the lesser risk. And from the class notes, don't copy and paste the class notes because that'll kill you, but in your own words and from your class notes, from your lectures, answer that one. And then you get 2, you have 3 to pick 1 from. So the question about does diversification work, you have that entire PowerPoint, that discussion there that you can definitely do. Case studies, we'll see if we can get there or not. And then we're right now working on this one. So of the 3 you get to choose from, we've only done 1. If you want to do that one, you could start now on that question. And then the credit spread, we worked a couple of those examples, really easy problems. So you can, that one should be a gimme. And then the huge value risk question that we haven't done in a while, but you knew it when we finished the last one. Now you're like, I've never seen that before in my life. So you'll have to reacquaint yourself with it. But that is going to be the exam. The only thing is, how far do we get on the case studies or not? Are any questions on that? I don't know when the exam is, May something. Yeah. All of these, just to remind you that number 1 and number 2, you submit on Canvas. So it's essentially open book, but your biggest mistake would be copy and paste. If you do that, if I'm reading my own notes, I already know what I think. I need to hear it in your words. So that's the biggest risk there. All right. No questions on that. I don't know when I'll put that up there. It kind of depends on when we finish the cases. We're a little bit behind. Then the other thing you have is the paper, the risk project. Here's some example papers. No, I'm not going to put them up on Blackboard because I don't want everybody to just copy them. But you don't necessarily need an intro, but you certainly could if you wanted to. Usually, to me, the intro is this is what I'm going to do in this paper. So there's 2 ways you can take this paper. You could say you're writing it to the client, you're going to give it to them. The problem with that is they may not know what a stock is. So it makes it really tough. What do I define? One firm really messed up this poor woman's account. So they gave her a free one of these and she showed it to me and it was absolutely horrible. So it was actually worth less than what they charged her because it was so horrible. But she reads it and she goes, well, what's a mutual fund? So I was like, yeah, this whole thing's because she wasn't going to understand it. That was on her field. She didn't have any background in it. But they essentially told her to buy stocks if they're going up and avoid stocks if they're going down. That was essentially the summation of their. I was like, well, that's really good advice for someone who doesn't know what the mutual fund is. That might be a little tough to carry out. So it was worthless, but they gave her some pieces of paper to kind of pacify her because they messed up her account. But you can, I think a better approach would be you're writing this for your boss, who's a wealth manager, for one of your clients. You take that approach. That way you don't have to define simple terms. All right. So that might be a better approach. So you say what you're going to do, and then you define your client. I don't need really pick, y'all know that taking my investment class, the most important thing is horizon. Is this a young person retiring in 50 years? Is a 60-year-old about to retire? That's the most important thing. Some people get a little bit more active, but you saw the current portfolio there. And then you're going to get into the efficient frontier. So the constraints, have to write something on constraints. You can Google stuff. I don't know what comes up on constraint for high yield. Something will probably come up. It doesn't look like anything's good to come out, but if you typed it correctly, there probably is some discussion out there on what's the max you should have on high yield. So what most people do is they have a little bit of discussion for each one. Maybe they show theirs. Remember, you can have any constraints you want except for the ones that I already have in there. So you just can't use mine. But some discussion. And then the assumptions is really easy because you're using my assumptions. But I actually think this is really critical. If you have a wealth manager and they're giving you efficient frontier, I would start asking, well, who did these assumptions? What's their background? How did they develop them? What was their theory behind it? So you don't have to do all of that for me, but you do have to say who your assumptions are. Most people just put them in there. Some people want like the butter me up, and it doesn't really help. So my great intelligent professor came up with these assumptions. That's not going to help you at all. But I'll probably just laugh. And then the efficient frontiers in there. And essentially what you're doing, you can see what they did is this was an older person that they thought had too high of a risk, so moved them down here. It's up to you as long as you explain it well. And then they did a good job here at cleaning that table up and then discussing it and why that might be the case. Now they did a little extra. They did the model without constraints. The reason I think it's interesting, you don't have to get into this, but it's kind of the critical thinking. It's the thing I discovered at USA. Once you hit a constraint, the efficient frontier's slope really drops. So at USA, once we hit the real estate constraint, the slope really dropped. And I really think once you hit one of those points, you may not want to go out any further on the efficient frontier before you have a discussion about why you have that constraint. For you, it might be emerging markets is where you're hitting first. Who knows? So you might be interested in the way you do that is, I mean, you can tell, right, looking at the table and seeing where you hit a constraint and kind of think, how is that hurting you? One way you can test it is if you have one that's hitting the constraint like 20%, you might rerun it. I mean, well, it takes like 10 minutes to run the whole thing, right? Just make sure you save it as a different file. Just rerun it without the constraint, put it at 100% and just see how material it is. If you're going out to say at 8% risk and it hits the 20% constraint at 6%, say how much more return could I get? I think in stats, y'all call that shadow pricing. You know, how much is that constraint costing me? Y'all remember that? It's probably been a few years, but you don't have to do that, but it's a little extra kind of stuff that you can do. I don't know if I'd put this model output in there because the person reading, unless your boss is familiar with the model. And then the final recommendation, what the recommendation. And then say, okay, well, my client did ask me about this mutual fund. Could they use this mutual fund for what we're recommending? What's your answer going to be? No, you can't do that because it's not going to match. But you still do the style analysis to see, because it would be nice if it were just really, really close because you're worried about tax consequences and those kind of things. So you run that style analysis, pretty simple to do. Was it Eric? You showed me. Yeah, I mean, it was amazing. The chart he got. It was pretty close. Not as right. Yours is a lot closer than that, right? You could almost not even tell the two apart. So you have the style analysis, and then the final recommendation is, can you see it? No, wrong allocation. And then the managed attribution. So my client also came to me, and since we're recommending large cap, they have this large cap manager they've been using. They just want to know if this is a good manager, should they stick with them? All right. So you see the discussion there. They did the Fidelity Blue Chip Growth Fund, which might be the first one in there. Yeah, this is a little bit much. I don't know if I'd do that. You know, that is one of the challenges of this, to take the mess of the Excel and somehow summarize it in a nice, meaningful way. And they just discussed that. They went in sharp Sortino. You can do the Sortino ratio if you want to look it up. It's not that difficult a ratio. The challenge is how do you calculate it? So you might be amazed that Sortino is not that difficult to calculate. It's focuses on the downside, but semivariance. I mean, you can look it up. You don't have to, but you know, you're building your war chest for interviews. So I think I was talking to Eric or someone on this, that Sharp is the one you see the most, but you almost only see Sharp ratio for hedge funds. I've never seen a mutual fund give a Sharp ratio. I'm sure there's some that do, but Sharp ratio is most popular. I've never seen Trainer or Jensen anywhere in practice. I've heard Sortino, but again, only from hedge funds. You're supposed to know these because we teach undergraduate, but you rarely see them in practice. I think a lot of PhDs that teach undergraduate and graduate, they think everybody's using these because they teach them, but very few people actually use them. So, and even hedge funds, I think, produce them because they're supposed to, not because they believe in them. So but it's good to know them. They're easy to calculate. They're not required, but they give you some extra critical thinking points. All right, so there's one paper. Here's a second one. So, kind of, if you're giving this to your boss, that opening paragraph probably doesn't make sense, but, it kind of depends on your background. And they give me names. I love some of the names. Some of them get a little bit hilarious, but yeah, but name Joel Trevino. So talk about who this person is. The asset classes. Now this one, they went in to define the asset classes. That's, if you're writing inference for your boss, would you do that? That would be overkill. It's like my investment class for when they write their paper and explain what the S&P 500 is. That's probably overkill. If your boss asks you to write a report on something, they probably know what the S&P 500 is. I don't count off for that. I think some students do it as more just to document for themselves what this is, and that's fine. You want to kind of capture that, but they're defining these asset classes. That's a little bit overkill, but it's fine. The asset class assumptions, the constraints. Yeah, I'm not sure what that is, but efficient frontier here. They're trying to say this person is way too conservative. Let's move them up. They went out of the way to make the pie chart a lot prettier. That's a lot prettier than what I had, wasn't it? I don't know how they did that. Maybe they did it in PowerPoint or somewhere. And then the VAR, they did get a job here of highlighting that. You notice how short the VAR section is. It's 2 or 3 paragraphs usually. It's not a whole lot. And then the style analysis. They did the T-row. Another good looking chart there. That's pretty good looking. That looks similar to what Eric had. This you can do. You can actually go to the website and look what they actually say they're doing. It can be really, really interesting to see if your style analysis got the same allocation that they say they have. So why would they be different, or what are they showing you? The allocation as a point in time. What are you looking at? The best fit over time. So it's possible they had 20% in small cap, but today it's only 10, and they're showing you today's. So that they can be different. They're usually pretty close. The one I showed y'all in class was actually pretty close. They can be pretty close. What's the single most important thing? Well, to me, the 2 most important things is the stocks versus bonds, and then how much international do they have? Those are the 2 things I always want to know. High yield's important, but high yield's rarely more than 5% or so of portfolio. The value versus growth right now I'm interested in. Just because growth has been so dominant, but I mean, there are certain things I'm kind of interested in. They don't tell you the value versus growth in here. They just say domestic and foreign stocks, but your style analysis will look at that. So you can kind of get into that. And then, yeah, they found other stuff. Yeah, some of y'all probably getting intimidated how to come up with this. They were just thinking, what else can I add? You don't have to add all the extra stuff. So I mean, I'm not showing you the D- papers. I'm showing you the good papers. So I haven't had the guts to show a bad paper before because I don't want to get in trouble. And then manager attribution, they did whatever fund that is. JP Morgan large cap fund, and just all the ratios. I like this approach of let's talk about the upside downside. Let's talk about beta, let's talk about alpha, but think about the order. I'd probably start with alpha, but maybe talk each section. Some students just give a massive chart that has everything in it and then just talk about it all in one massive paragraph. That's a little bit hard to digest. They did information ratio. I'll give you that. Batting average, it's 11. They did Sharp. Trainer, they did Sortino as well. So how would you calculate downside risk? So the way I used to do it, there was a big article that a guy named Brian Ron wrote. And so I called him. I told you I've done that before, right? You just call him. I had a long discussion with him. The poor guy got in a big debate with Roger Ibbotson in the Financial Analyst Journal. So it was month after month. Brian Ron wrote something to the editor. Ibbotson responded. Brian Ron wrote, "You don't want to be debating Roger Ibbotson in public. That is not a smart thing to do." So I called him right after that debate. So he was like, the guy just sounded like he was, his life was at risk or something. I mean, he was noticeably shaken, the poor guy. But his model was using downside risk. And he wanted to sell the model to me. USA is calling, so he's kind of excited. A client might be there. Unfortunately, he explained his model enough that you could do it yourself. So you're like, okay, thanks. I'll just try it myself. But essentially, all he does is he looks at all the returns that are below the mean. So find the mean, find all the returns below the mean. Just take the standard deviation of that, and that's how simple it was. Really, really simple. So they're trying to ask: are you more volatile above average or below average? That's called semivariance. Roger Ibbotson's argument was, he used Japan. He said, with your argument, Japan looked like a great place to invest in 1989, right before it crashed. So to say that Japan's not a dangerous place because all its volatility is on the upside, ignore the fact that when it cratered, it just flipped over. So that was his argument. unfortunately for Brian Rahm, that had just happened. So it was like the perfect argument. I'm not going to debate any of these guys in public, not in the financial analyst. I mean, he had some guts to do that, right? I mean, it's pretty gutsy. I would have stopped after the first time Idvison responded to me, but he kept trying, and he finally gave up. And a summary chart at the end. I don't need bibliographies, but if you want to put one in there, that's fine. That's kind of an intimidating bibliography, given that you really don't need anything. And then one last one. Looks like they're all written by the same person, but these are 3 different people. So Carl Haas, I don't know where that name came from. 22-year-old. Okay, so now we have a young person with 70% in stocks, 30% in bonds with a high yield focus. There's the assumptions, the exact same color as mine, so they just took it like it was. The constraints. And then the efficient frontier, just really basic. Of his risk level looks good to me. I think we can just get him a better portfolio. So y'all seen it. These are all pretty standard, aren't they? There's not a whole lot of variation here. Here they did a comparison of the 2 portfolios. If you want to find some way, I mean, it's really easy to do that. Style analysis. So if you're ever in trouble with the pie chart, I can certainly help you with that. The way I do it is I delete all the labels, then I'll re-add all the labels, then I'll say I want numbers, and then I'll delete the zeros. That's the only way I figured out how to do it, but there's probably a better way to do it. And you don't have to use it in Excel. If you want to take the data and stick it into a PowerPoint and get a nicer looking chart, you can certainly do that. It doesn't have to use that chart. And then the mutual fund, yeah, so while the fund's done well, I recommend Carl stick with what I have and don't use that fund. That's going to be the answer for every single one of you. And then 2 people in class are going to email me tears. I just spent 40 hours trying to find a fund that matched my allocation. And 40 hours means what? You just spent 4 hours, right? Students, you round up to the nearest 40 hours. So I just spent 4 hours looking, and you don't need to do that. You're going to say no on that. I can't imagine there will ever be a fund that's going to match the allocation we have. And then manager attribution. I don't know why she has multiple firms here. And then final recommendation. Oh, have the student's name there. Sorry about that. All right, does that feel kind of comfortable? So tell me again, what's the order? You start off with
Horizon.
what?
Horizon.
Yeah, so the client. So maybe some quick introduction. I don't know what that would be, but then what do you do?
Their portfolio.
Well, that's part of the client, right? What are they invested in? What's their age? Second thing, even before that, the constraints and the assumptions, right? Why am I making you put that in there? Because most wealth managers don't. They just assume, hey, I'm a wealth manager, trust everything I do. It's like, no, that's, if you have bad assumptions, remember, garbage in, gospel out. You have bad assumptions, then hiring you is a waste of money. All right. Then the third thing is your recommended asset allocation using First Frontier. Then what? Historical. Okay, risk. Why are you doing that? It's to let them know, hey, I'm recommending this thing based on future assumptions. However, I just want to show you how this would have done using historical data. How many wealth managers do that? None. They're scared to do that. All right, then you're done with your analysis. But then you say, what? Oh, by the way, the client came in with this portfolio. They're wondering if they could use that. And your answer is going to be no after you do your style analysis. And you have one last thing. What's the very last thing there with batting averages and the manager attribution? So you finish your analysis, you're done. And then you say, oh, by the way, my this person came with two portfolios. One's a balanced portfolio. They want to know if they can use that for the whole portfolio. And I said no on that, but they also came to me with this large cap manager or small cap manager. They want to know if that's a good manager. All right. So those are your last two. They're essentially after the fact. You could even set it up like that. After completing this analysis for them, they asked me about these two funds, and you could work it that way. All right. This is a great paper to put on LinkedIn. It really, really is, because you're doing exactly what wealth managers do. You can see they went a little overboard because they wanted to look good on LinkedIn. So they added a little extra stuff, nice colors, all that kind of stuff. Any questions on this? It's not a particularly difficult paper. All right. So let's keep going with Taleb here. So we started off with Taleb. He doesn't like the normal distribution, the way it's used in finance. We over rely on that. We get easily confused between luck and skill, and we just don't even worry about it. We just pay luck. We give them we give them a bonus. Anyone who outperforms must be good. The third thing he doesn't like, well, we talked about that one. Where'd we go? Okay, let me see. All right. So we kind of talked about this already. We're fooled by randomness. Again, that's very similar to the second one. We see patterns of randomness and create a model to sell to the public. So number two is we compensate people for randomness. That seems to be the same as number three, where we're fooled by randomness. They're slightly different concepts, though. So we see random noise and mistake it for information. Why? Because our bosses want us to find information. So my boss was every day, what are I going to do? What are I going to do? It's like the same thing we're doing yesterday. So you got to be doing something. I always like to quote Warren Buffett said, investing's like batting where no strikes are called. That would make Major League Baseball really boring if they didn't call strikes, because you just wait until the pitcher is completely worn out. And that may be true. So what he's saying, if you're patient, you can do really well in investing. The problem with that is we're paid for swinging in finance. And since we're paid for swinging, we don't care that they don't call strikes. We got to swing. Why? Because everybody's like, what did you do for me? Which implies you're going to do something. And if you're not doing something, you're assuming you don't know what you're doing. You're not skilled. The problem is that our ideas are sticky. We produce a theory. So we see something that's not really there, but boy, we stick with it. Why? Because we invest our egos into our ideas. We'll talk about this when we talk about Annie Duke. Don't ever invest your egos. So always give yourself an out. I think the Fed's going to cut 3 times this year, but here's some reasons why they wouldn't. You set that up immediately, right? So don't say, hey, the Fed's going to cut 3 times this year, and then you're like, okay, now my ego is invested in that. They better cut 3 times this year. We're not likely to change our minds. So those who delay developing the theories are better off. I like the way he says it, and it may be here, right here. Don't use the word because if you don't know the because. So your boss comes in and said, why did markets do this? Oh, because. So, well, one theory says it might be this. We don't really know. Don't commit your ego to these ideas. So those who delay in developing the theories are better off. When you develop your opinions on the basis of weak evidence, you're going to become what's called, I don't know if you've heard of confirmation bias. So if you invested your ego, you have a position, and now anytime you see something that supports it, oh, you're going to read on that. You feel so smart. See this big time investor is saying the same thing. Anything disagrees with you, oh, that idiot, they're always wrong. Your brain will automatically go to things that support what you already believe. So even if the information is more accurate, we just don't want to hear about it. It takes considerable effort to see facts while withholding judgment. And I do think it's the way finance is compensated. People just think we're out there seeing stuff all the time. We're doing stuff. But, the general public doesn't realize how ignorant we really are in finance. We don't know any more about the future than anybody else. And they expect us to have these opinions, so we state them. Where do you see that the most? Where you just look on TV, when they interview people in finance, boy, they sound really confident, don't they? How good are they at their estimates? No one cares because no one ever goes back to the tests. But so I love this right here. We are better at explaining than understanding. Isn't that a great quote? Why? Because we're pretty good at making up stories. And the funny thing is, when we make up a story, we don't know what we're talking about. But once we make it up, we're really confident in what we just said. So we're pretty good not at convincing others. We're really good at convincing ourselves because we want to be right. My biggest problem with the educational system lies precisely in the fact that it forces students to squeeze explanation out of subject matter and shames them for withholding judgment. You are criticized for saying, I don't know, even though that's probably true 90% of the time. Have the integrity to deliver your because very sparingly. I'm not a big Harvard fan because I hate case studies. I'm sorry if you're in a case, any of y'all taking case classes. Yeah, I don't like it. Don't tell that professor. I think it's incredibly artificial. And I think it's incredibly arrogant to think some Harvard grad student who has 2 years of experience is going to look at a massive firm and say, oh, this is what the CEO needs to do. These firms are far more complicated than that. And reading a case for 2 hours and now you know exactly what should be done. It just seems crazy to me. And most of the cases are so overly simplified that if you actually did the recommendation that Harvard comes up with, it wouldn't work. It's just so the world is far, far, far more complicated than we want to admit. Listen to the news. Well, here's the other thing he says there's a lot of noise because we're constantly being forced to give opinions and stuff we have no clue about. What we're hearing on the radio, what we're reading in the Wall Street Journal, a lot of that is just pure noise. So he says, listen to radio every hour is far worse than reading a weekly magazine because the shorter the interval, the more just bad information. So I don't read the Wall Street Journal. I read The Economist. I love The Economist. It's weekly, but it's probably made too short term, but it's at least filtered out so that's, it's not a daily kind of thing. How do you know that's true? He says, spend the year reading last week's newspaper. So get the Wall Street Journal, but read it a week late and see how many of the articles are now just completely useless. So that's one of my few quotes from that book. All right. So he's kind of gone a little further that we're fooled by randomness. It's almost we're forced to make a decision, so we have no choice but to interpret randomness because our bosses are expecting us to say something. And how do you manage that? How do you get around that? And I don't know. I couldn't manage my boss. All right. Taleb, his fourth point is, well, he's very anti-experts. Experts and elites know far less than we think they do. We spend a great deal of time listening to them and following their advice, but we rarely go back and see how accurate they were. And they themselves really don't know how bad they are. I love it when they introduce someone, this is so-and-so, they called the 2008 crisis. They've been wrong ever since then, but they called that, but that's how to introduce them. Oh, she called the 2008 crisis. All right. Y'all, I don't know if y'all don't remember Dr. Doom, a guy named Dr. Doom. He was in the newspaper. He was this famous guy because he called the crisis, and he called 9 of the next 2 crises after that. I mean, it's just, he was so wrong. But I mean, that's actually really smart to do. You should predict a major crisis like every week. Eventually you'll be right. And that's all anybody's going to remember. So it works really, really effectively. Nobody knew anything. Well, this is kind of an extreme comment by him, but elite thinkers thought they knew more than the rest of us because they were elite thinkers. And if you're a member of the elite, you automatically know more than the non-elite. There's been plenty of studies on this to show that elite thinkers are many times worse than the average person on the street. So what does Taleb think? Let's see if you see this is worded kind of negatively. The expert is the closest thing to a fraud, performing no better than a computer using simple metric. Their intuition getting in the way of and blinding them. What is intuition? So you'll hear an expert say, hey, I can't use those models. I got to have my professional intuition. Yeah, I think of intuition as bad statistics applied to horrible memories to make decisions. That's what intuition is. And we're going to talk about memory. What Kahneman says about memory, I think, is really critical for finance. We don't, you know, well, I don't want to get ahead of the game, but yeah, we don't remember our experiences. We remember certain things about our experiences. We actually forget a huge part of our life. And the way our mind remembers is actually really good for our egos, but horrible for our decision making. And when you see the statistics on that, you start realizing that, yeah, you really can't trust your memories at all. You really shouldn't. But that's what intuition is. Bad statistics applied to faulty memories. For professions that deal with future and base their studies on non-repeatable past have an expert problem. So this is real key for him. When experts are talking about the future, it's a huge problem for him because the future is a really hard thing to talk about. I'm not saying that no one who deals with the future provides any valuable information, but rather that those who provide no tangible added value are generally dealing with the future. The problem with experts is that they do not know what they do not know. They are quite ashamed to say anything outlandish. I mean, that's the other thing you see with economic forecasters. They're all really close together. And they're all also really close to what the last number was. So if the last GDP number was 3%, no one's going to come out and say negative 7%. Why? Because you want to be pretty close. And yet events turn out almost always outlandish. Economic forecasters tend to fall closer to one another. In a study comparing an investment analyst with weather forecasters, who is better, weather forecasters or finance? Weather forecasters are better. Who thinks they're better? Finance. How does that play out? The less accurate or more confident in their accuracy. That sounds like a disaster, doesn't it? Economic forecasters tend to fall closer to one another. In a study comparing them, document that analysts are worse at predicting while having greater faith in their own skills. They expose an expert problem. There was no difference in results, whether one had a PhD or an undergraduate degree. Have y'all heard of Tetlock? I'm a big fan of Tetlock. You also read his books. His Super Forecasters is a really good book. He's written some other books, but really good writer. Found a negative effect of reputation. Those who had a big reputation were worse predictors than those who had no reputation. The studies collectively show no convincing evidence that economists as a community have the ability to predict. And if they did have some ability, their predictions are at best slightly better than random ones. Not good enough to make decisions. They reached a sad conclusion that statistically sophisticated or complex methods do not necessarily provide more accurate forecasts than simple ones. The world is far too complicated for what we're trying to do. So he doesn't like experts. I don't know if he considers himself an expert, but he does not like experts at all. All right, let's get into the black swans. He doesn't say black swans are important. He says black swans are all that matter to history. They're 100%. Taleb argues that the massive and rare events that most explain what is going on in the world, we ignore these events because they're so rare, and yet they only turn out to be almost all that matters in our lives. A small number of black swans explains almost everything in our world. Ordinary events, the ones we study and discuss and try to predict, have become increasingly inconsequential. We spend a lot of time talking about stuff that doesn't matter because we don't know how to talk about the stuff that's the most consequential but extremely rare. Why do we keep focusing on minutia and not the possible significant large events and the obvious evidence of their influence? Life is a cumulative effect of a handful of significant shocks. And I can attest to that. I should write down my life. I think there's like 4 days is my entire life. I mean, I remember I changed majors from music to accounting. I mean, it was 2 conversations. So a professor, so on the music side, I was in conducting class. I finally had a good conducting professor complimented that this is great, but he wasn't one grading me. The other person was grading me. She gave me A-. I finally got an A-, but guess what was below that? She erased her B that she always gave me A-. And I looked at it and go, she's telling me on my best day, I'll be mediocre. So I changed majors. That was like 30 seconds to radically change. How did I become an accounting major? The French horn player said her roommate was an accounting major. Don't do that. It's too hard. So I became an accounting major. All right. My entire life was decided in, I don't know. I don't even think it was 30 seconds. I think it was less than 10 seconds. My entire life, I became an accounting major. Your lives can be the same. I have students coming to me want to help help them plan the next 50 years of their lives. You can't do it. You don't know who's going to offer you a job. I want to be an investment banker. Okay, it's great if they offer you a job. If they don't offer you a job, you're not going to become an investment banker. You know, there's so much randomness in here. And how do I come in finance? The CFO of my company usually walked that way. He decided to walk this way one day. And I thought I'd show off and say, hey, I saw a job on board. I thought it was interesting. I didn't want that job. I wasn't interested in that job. He went back, called the head of the department. I was working there 2 weeks later. I went from accounting to finance because the guy turned left instead of turning right. All right. Those are black swans that your life is going to be 3 or 4 of them is going to define everything. Does that mean you don't plan and study? Well, no. I mean, I was ready for that job when it happened because I've been studying, but I mean, that's your life. You can't plan out your life. It just doesn't happen. And that's what he means. Those are small black swans. It's just my life. But, you know, there's 3 or 4 events in my life that radically changed everything. You're going to find the same thing. He's saying that's the same thing for economies, markets. The normal is often irrelevant. We focus on that. Life is cumulative of a few major shocks. In this essay, I stick my neck out and make the claim that our world is dominated by the extreme, the unknown, the very improbable, and all the while we spend our time engaged in small talks, focus on the known and the repeated implies the need to use extreme event as a starting point and not trust it as an exception. The future will increase. Now, this is his other argument, which I think is a little scary, but it's interesting. He thinks the world's going to have periods of amazing stability, followed by crisis, followed by amazing stability, followed by a bigger crisis, stability, bigger crisis. So he thought 2008 was bad. He's saying the next one's going to be worse. And he says it's because of what's happening with globalization, and we're just so much more integrated with each other. And finance has become so complicated, we don't really know all the moving pieces. And what would make that even worse? You think AI might make that a little bit more challenging, where we're trusting the computers to make decisions. So it's a little scary. I don't know if he can prove that that's the case. But it's a little scary. How often have you, doesn't make sense, does it? How often have you arrived 1, 3, or 6, have you arrived, 1, 3, or 6 hours late on translate flight as opposed, when's the last time you arrived 3 hours early on a flight? Doesn't happen too often. I've arrived 28 hours late. So a flight is much faster, but the standard deviation is pretty high. But where is the standard deviation? It's all on the downside. I did this math once. Should I drive to Houston or take the plane to Houston? And so I looked at the time, which has a higher standard deviation as far as arrival time, do you think? The flight, yeah. Which is going to have the better mean? The flight. Should that influence your decision? You know, on average, I'll get there 30 minutes earlier. I got to account for going to the airport, standing in line, all that kind of stuff. However, I got a risk of it taking my flight getting canceled. I get there 5 hours later. That should become part of your analysis. So those rare events might change your decision just because, and he's going to talk about this when he talks about anti-fragile. There's times where you avoid things because that downside, even though it's extremely rare, is so huge it destroys you. Risk management professionals look in the past for worst case scenarios. What do we know about the worst case scenario? It wasn't the worst case scenario the day before it happened. All right, so that's the case. So what about the next worst case scenario? It's going to be worse than that worst case scenario because it's going to be worse than the last time. So, yeah. They take the worst historical recession, war, whatever, as an exact estimate of worst future outcome, but they never notice the following, the so-called worst when it happened exceeded the previous one. All right, so there's a fifth one. Obviously, this is his big focus because he's worried about these black swan events. That's a big part of this analysis. All right, if we're fooled by randomness, what else are we fooled by? He says we're fooled by calmness of markets and economies, and actually prefer risk with low volatility but huge downside. So he says we actually prefer black swans. Why? Because they trick us. They seem so calm. They give us great returns. They're nice and calm. So we kind of get lulled into that. So we kind of, that's our preference. We forget about that huge downside that can hit us. So we forget that it's extremes. There is contagion. We're going to talk about contagion when we talk about that. Covered, how important that is. Why are tall events so huge? It's because at some point in the tail, that event starts affecting a bunch of other things. And there's this kind of domino effect. You don't get it on the wave, but once you hit a certain point, where does that point happen? You don't know. Well, you know when it happens. And it's almost like you move one more inch to the right and suddenly everything falls apart. Right before that, everything's just holding together, barely holding together, and you move that one extra inch. And suddenly a kind of big event becomes a massive event. And that's what contagion is all about. People are often ashamed of losses, so they engage in strategies to reduce little volatility that contain a huge loss. He calls it collecting nickels in front of a steamroller. I don't know why you do that. Nickels, you're picking them up, you're loose, they're real easy, right? You don't see the steamroller coming toward you. In Japanese culture, is that we're ill-adapted to randomness and badly equipped to understand that bad performance can come from bad luck. Losses can severely tarnish someone's reputation. So there are some cultures that small losses, you just get beat up, and you're encouraged to take something that has few losses except for one massive one. People hate volatility and thus engage in strategy exposed to blowups, leading to occasional suicides at their big loss. I learned about this problem from the finance industry. We see conservative bankers sitting on a pile of dynamite, but fooling themselves that their operations seem dull and lacking in volatility. We saw that with the guy from AIG. It used to be, this isn't true anymore, but bankers show up, blue suits, white shirts, red ties, 8 of them. It got really irritating at USA. We met with 6 banks today, and I can't remember which one's which. They're like 6 the same.
Does Taleb ever give an example of a low volatility scope at the blowout?
He does in the book.
What did he mention?
I mean, a good example one would be what happened in '87. So people were selling put options really deep out of the money. They're collecting, it's like collecting these dividends. It was like when people are doing senior citizen loans. It's like your dividend check. Works really, really well. When does that blow up? Market falls more than 10%. It fell 23%. They just got wiped out. But for years and years, it was wonderful. There's that collecting this money. So that's kind of a big one. But yeah, I can't remember how many he gives in the book and which book. Probably in Black Swan, he probably gives a few examples like that. He gives some examples of actual friends he had that were traders that were doing this, and he talks about their trades and why they blew up on them. And it's funny because he talks about how they got these big bonuses, and then they're in these nice houses, and then the next year they're unemployed and they're selling everything because that one event finally happened. All right, now he talks about the FAA or the whoever does airplane safety. He loves them compared to finance. So he says every plane crash brings us closer to safety, improves the systems, makes the next flight safer. Those who perish contribute to overall safety of others. These systems learn because they are anti-fragile. So what does anti-fragile mean? I don't like the book Anti-Fragile. I like this concept. I've had some students, and I don't see anything there, but I kind of like it. So he says there's 3 types of people. There's those people who are betting against volatility and they're crushed by volatility, extreme volatility. There's people that are resilient. Volatility hurts them, but they survive. And then there's the anti-fragile. The anti-fragile are people who benefit from high volatility, not normal volatility. They benefit from high volatility. So the anti-fragile are those people who win when markets blow up. All right. And he makes a really, really, I hate to get ahead getting here.
Did the anti-fragile lives in certain randomness?
Well, I want to no, it's a quote I really love of his. Right, I'll tell it to you now and we'll see it again. So we'll see it twice. But he says you cannot measure risk, but you can measure predictions. So we don't really know what risk is. We saw that with defining risk. You can't measure that. Standard deviation is not a measure of risk. Correlation is not a measure of risk. Beta is not a measure of risk. But you can measure how anti-fragile a person is. You can measure how much exposure they have to volatility. He says that's the measurement you should be interested in. How do you do if the stock market crashes 40% or interest rates shoot up 500 basis points? Right, so I might get back to that for you. I'll find it here. So they were set up to exploit small error. The same cannot be said of economic. So yes, so plane crashes or even close calls. I watch those programs, man. I watch them all the time. I love the ones where at the beginning of the program, they're interviewing a survivor. That one, those programs I like. Because I'm always like, did anyone survive? And the ones that no one survived. There's some, I don't know if you've seen, like 2 people survive out in the jungle. It's just pretty amazing. There's some pretty amazing stories, really sad stories, but it's amazing that so many people survive. And some of them pretty incredible. Y'all have heard of the Hudson miracle in the Hudson, but there's a guy in Asia did almost the exact same thing. It looked like it's 10 times harder. And no one talks about him. Pretty amazing. So there's some amazing stories. All of those stories, no matter what they are, these people come in and see what happened. Even though no one died, everything worked out, they want to know what happened because they don't want that particular event to ever happen again. What can you say about economies? That cannot be said of economic crashes, since the economic system is not anti-fragile. Why? There are hundreds of thousands of plane flights every year, and a crash in a plane does not involve others. He's getting back to all planes are not connected to each other, whereas we're all interconnected. So it's a much bigger system. Errors remain confined and highly specific. I don't know if AI will change that. It kind of worries me that, I mean, how much time do pilots spend flying a plane? It's like 10 minutes on takeoff and 5 minutes on landing. It's not much time. The computer is doing most of that. Is it possible that planes might be more connected? That's kind of scary. A crash in plane does not involve others, so errors remain confined and highly, whatever that word is. Y'all use that word in normal conversation. So find out what this word means and use it this week in a conversation. Let's see how it goes. Whereas global economic system, and don't even know what it means. Just use it randomly as if it fits. Whereas global economic systems operate as one, errors spread and compound. We are talking of partial, not general mistakes, small and not severe terminal ones. This creates a separation between good and bad systems. Good systems, such as airlines, are set up to have small errors independent of each other, negative correlate to each other, since mistakes lower the odds of future mistakes. This is one way to see how one environment can be anti-fragile and the other fragile. If every plane crash makes the next one less likely, every bank crash makes the next one more likely. We need to eliminate the second type of error, the one that produces contagion. In that word, contagion is so important in our construction of an ideal socioeconomic system. I don't think he's really giving us a solution here. We're interconnected. I think his solution is don't rely on that calmness, because when it blows up, it's going to be bigger each time because we're more and more and more interconnected. You're seeing that more now as China becomes larger, and we're having this debate about, which currency is going to dominate, and everybody's trading with each other, and bank systems are tied to each other. I don't know how Bitcoin's going to fall into all of that. The Federal Reserve's talking about federal kind of a bank. I forget what they call it, bank account. What's it called again? Yeah, that's kind of scary too, isn't it? I mean, you get more and more interconnected. So who knows? I'm retired. I don't worry. I'm just trying to freak you guys out. All right. The next thing he says, we should bet on flat tails. Right now, finances assumes they never happen again. He's saying you should actually bet on them. This is where Kahneman most debates Taleb. Says, Taleb, you can do this because you're wealthy. You have plenty of time to wait. The average person out there in their 401k can't do this. So what he's recommending is for a few rich people with time to waste on their hand. But he says you should bet on the fact. What's wrong with the fat tails? Well, it's a fat tail, but it still doesn't happen that frequently. The fact that you're going to wait 5 or 6 years to have a big payoff, most people can't do that.
And most people don't know how to do that, right? He's talking about derivatives and trade that most people can't do. So that we benefit from them rather than being destroyed by them. That's what he means by anti-fragile. You need to put a portion in the safe investments like T-bills. So essentially he's saying low risk and then bet the other on a black swan. Pretty radical allocation. The remaining should be put in extremely speculative bets as leverage as possible, preferably in venture capital style portfolios. There are both positive and negative black swans. The dovetail strategy making the maximum exposure to positive black swans while remaining paranoid about the negative ones. Do not try to predict black swans, especially precisely. You don't, if you're going to say, hey, the stock market falls 50%, why would it do it? He says, you don't need to figure out why, just assume it's going to do that. Invest in preparedness, not prediction. All of these recommendations have one thing in common: asymmetry. This idea that in order to make a decision, you need to focus on the consequences rather than the probability. It's a central idea of uncertainty because he doesn't really think we know the probability and the probabilities are changing. Much of life is based on it. I worry less about small failures and more about large, potentially terminal ones. I worry less about embarrassment than about missing an opportunity. In the end, this is trivial. I am very aggressive when I can gain from black swan, when a failure would be of a small moment, and very conservative when I'm under threat of a negative black swan. Most people do the exact opposite. They bet on black swan because they happen so infrequently and they get paid for it, but not paid adequately for when the black swan happens. And it's possible you can go 10, 15 years without it happening. You're collecting those nickels, but then eventually it's going to happen. I'm very aggressive when error can help me, paranoid can hurt me. It's exactly what people do not do. The best description. Now, one thing interesting in Taleb, he made a fortune in 2020 with COVID. What they didn't say, so this was in March, what they didn't say what happened to him in May and June. So yeah, his portfolio had a huge gain, but then the market snapped back. I'm guessing he had a big gain and he lost it all, but we don't know because he stopped talking when it snapped back. We don't know what happened to him. So even in that case, he was right. We had this big event, but did he get out of it in time or did he stick with it? You know, that's the hard part to know. I've got a process on those type of markets that gets me investing a little bit different approach than he did. There's ways to handle these events that I think work pretty well. Description is skewed bets. I try to benefit from rare events. So the exact opposite. He's trying to benefit from rare events versus just assuming they don't happen and invest normally. Accordingly, present a large payoff when they occur. Try to make money infrequently. That sounds kind of crazy, doesn't it? As infrequently as possible. Try that with your boss. Hey, my goal is to make money as infrequently as possible. So just, you want to hire me now? Simply because I believe that our rare events are not fairly valued and that the rare event, the more undervalued would be priced. So he's saying, yeah, you're wasting some money investing in this because it's unlikely to happen. But what you're investing is so small, you're not losing that much. And when it happens, you're going to be more than compensated for making the bet. How many Americans can actually invest that way? Very, I agree with Kahneman that he was like, yeah, you're a unique. Here he talks about a meeting he had. So he was asked his opinion. He said, I think markets are more likely to go up, but he's shorting the market. And so why would you do that? Let's assume your reader shared my opinion. The market or next week had a 70% chance of going up and 30% chance of going down. But if it goes up by 1%. If it goes down 10%. So that's what he's thinking. It's not just the probabilities, it's the consequences. What would you do if the reader is bullish or bearish? Accordingly, it is not how likely the events to happen, it's how much is made when it happens to be considered. Anti-fragility is beyond resilience or robustness. Resilience, those people who can survive, which is good, but they still get hurt. I hate the word robustness. That was the catchphrase for like 3 years. Every single manager came to meet with us. We have this robust model. I'm so sick of robust models, but and most of them don't know what it means. I mean, it kind of means healthy. I don't know how an Excel model is healthy, but a healthy model The resilient resists shocks and stays the same. They're anti-fragile. So the resilient kind of just handles it. Those are, has some losses, kind of handles it. Anti-fragile actually makes a fortune. Right. Okay, here's the quote. I like it when I found it. Is this the one you were mentioning? I didn't hear exactly.
No.
This is the one I meant. Fragility can be measured. Risk is not measurable. In casinos, they are. Right? You can measure. So would you recommend people do gambling? Depends. Are you the gambler or are you the house, right? Why is it okay to be the house? Because they know the odds in their favor. Even when they mess up, they say, wait, you didn't win $1 million, the machine messed up, and they can take the money back, right? They don't have to give it to you. So they, even when the machine messes up, they can say, no, everything has to be based on the odds. So yeah, the house, that's a place where you can be pretty confident. If you're a gambler, your pure luck is always going to help you. We can almost always detect, and he says not only can you measure it, but you can detect it fairly easily based on asymmetry. How exposed is that person to asymmetry? If they're highly exposed to it, then they're fragile, they're not anti-fragile. Anything that has more upside than downside from random events is anti-fragile. The reverse is fragile. So I think this is the key to anti-fragile. I like that concept that you can measure fragility better than you measure risk based on this concept of asymmetry. It's an interesting concept. That is the entire book, though. The book's much longer than that, but that is, if you read that paragraph. So I'm not a big fan. He says it's the best thing he wrote, that you could throw out his other books. That's all you need. I strongly disagree with that. He has some really strange paragraphs in that book. It's bizarre, so I don't know why. But anyway, don't you wish you were here? I think he would charge us like $80,000 to come speak here. He got so wealthy that I don't think we can afford it. All right, his last one is on forecasting. We kind of implied that already. Forecasting is necessary. I don't actually agree with that. It depends what he means by forecasting. I was going to show you the Paul article, but we got behind. If you're going to forecast, I think you forecast distributions. You don't forecast the point. If that's what he means, I think that's fine. I do think we should, in that cone of uncertainty, we should forecast what we think the distribution is and be as honest about that as we can. We'll see that with Doug Hubbard. But we shouldn't make bets based on our confidence in a forecast. Some confidence is never warranted. I find it scandalous that in spite of empirical record, we continue to project the future as if we're good at it. Why on earth do we predict so much? We don't talk about our record, and that's just so true. I strongly recommend this. Soros is famous for his investment dictionary or diary. I recommend you do it. Every single trade you do, write it down and why you did it. So you want to say, I bought XYZ because. Now, why do you want to do that? So we're going to see this with Annie Do. So I bought Apple stock because I think their margins are going to expand next quarter. Apple stock goes up 10% and their margins contract. You right or wrong? You're skilled or lucky? The reason you said it's going to go up didn't happen, and it still went up. That sounds like luck to me. All right. So what you're trying to do is, was it luck or skill? If you don't collect this information, how do you interpret every single good trade? Skill. How do you interpret every bad trade? Unlucky, man, this market's just went against me. So Annie Duke's going to talk quite a bit about that. So why don't people like doing this? Because it's incredibly painful. We did this in Investment Society. I stopped doing it mainly because it's time consuming. It's also really painful. Every trade we did, so if we sold Apple and bought Microsoft, at the point we did the trade, we tracked those two stocks going forward. Oh, it is so horribly done. So painful. I remember one of our students, we bought Whole Foods. and its stock shot up because Amazon bought it. And I remember hearing him saying, yeah, we were talking about Amazon taking it. I was like, we're talking about that. I remember having that conversation. The reason we bought Whole Foods had nothing to do with Amazon or they getting bought out. But he was so confident, I think he might have even believed it. But it's like, yeah, we never had that conversation. That wasn't our. So Soros says, write it down. It's painful, but what happens over time? And that's what Andrew says. You've got to know when it's luck or skill to improve your decision making. If you think all the good trades were skill when it was luck, you're going to be a horrible decision maker. So that's why she talks about thinking and bets. You've got to know the statistics behind your decision making to improve those statistics. What you should avoid is unnecessary dependence on large-scale harmful predictions. Only those. Avoid the big subjects that may hurt your future. Be fooled by small matters. Demands, if you're worried about if it's going to rain or not next picnic, you can predict that because if it rains, you get a little wet. That's not a big deal. Avoid government social security forecast for year 2040. Know how to rank beliefs, not according to their plausibility, but by the harm they may cause. That's a pretty good one. I used to joke with our actuary because he would give us our pension projections out for 75 years. And say, in year 69, are you sure about that mortality rate? I have no idea. He was like, yeah, I'm pretty sure it's right. We are going, that's the pension forecast out 75 years. How ridiculous is that? And we have to predict inflation, interest rates, stock market. We have to predict all of that out 75 years. We'd be horrible just predicting the next year. But out 75 years, yeah, we have to do that. And that's going to be a liability on our balance sheet. And it's just ridiculous. Anyone producing a forecast or making economic analysis needs to have something to lose from it. Andy Duke's going to talk about this as well. That's why those predictive markets are somewhat useful. When you get people to put money on the line, they tend to give you better forecasts. Forecasts induce risk-taking. They are more toxic to us than any other form of human pollution. Forecasts get us to do stuff we wouldn't have done without the forecast, even though the forecast is completely useless. These same forecasts are really painful. All right, what do you think about what Taleb has to say? He's insulting your profession. No, we have actuaries in the room. So I had an actuary speaking to this class once, and a student asked him about Taleb. You should have seen that guy. He got so mad. It's insane. Taleb's talking about you guys. He's not talking about actuaries. There's some truth to that. We'll see that with Doug Hubbard. Doug Hubbard has a high respect for engineers and actuaries. He doesn't like economists and finance people as much. Is it because we're stupider? No, it's because what we're trying to forecast is much harder to forecast. It's much easier to figure out how many 50-year-olds are going to die in the next year or 10 years than it is to figure out what interest rates are going to be in the next 2 years. I mean, it's possible something changes with 50-year-olds. You have a pandemic, you have fentanyl, those things going on, but it doesn't, you don't go from 2% dying to 73% dying. You go from 2% dying to 2.1% dying. I mean, so actuaries do have it a little easier because their data is a little bit more predictable, or at least has been. It could radically change. We're talking about that in the P&C class because AI is starting to move into this industry. So who knows what's going to happen. But actuaries have better data, and they are better at the data. They do tend to be a little more skeptical of data. But he's insulting your profession. Do you agree with him? Is he just really wrong, or is he right on the mark? Who just strongly disagrees? Is he wrong on all of this? The actuary said, yeah, he's exactly right. So if you agree with him, what are you going to do with it? I think the most important thing is on predictions in your ego. Always, and we're going to talk about this always with Andy Duke. It's not what he thinks is going to happen. It's what the range of things you think can happen. And how do you benefit if you're up here? How do you lose if you're down there? If you can't stand this, you got to do something to manage that distribution. It's all about distributions. And the distributions we're going to see with Doug Hubbard, if we think this is a distribution, he's going to say study shows it's actually this. What we say is a 90% range is actually only about a 60% range. We're way off in our predictions. And he talked about calibrating. So Andy Duke and Doug Hubbard, there's a lot of overlap in these two people, which is is interesting, that they could come to similar conclusions. All right, so Kahneman. Any questions on Taleb? Now y'all don't want to read his book, do you? Yeah, I showed y'all this before. Maybe I could show a quick excerpt of it. I don't think Taleb comes out well on this interview. Kind of bad mouthing him a little bit. Now, Kahneman's the one asking the questions to Taleb. And he'll ask a question, and then he'll have these kind of pontifications. And what he normally does is ask a question, Taleb answer it, and Kahneman would say blah, 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 and actually destroy what Taleb just said. And it's like, my next question is, Taleb's like, wait, just kill me there.
Things getting big. People searching for economic scale and people.
So he's doing a lot of talking there, but it's a really, really good. You got two giants of our profession. Kahneman's still alive. You can watch a lot of his lectures out there. There's a couple of them I really want you to watch. This is the kind of stuff I would be watching for you at this point in your career, hearing what these people are saying. Taleb had a big impact because his book was so popular, but criticizing some really basic financial parts of finance. Kahneman, he's not an economist. He's not a finance person. He's a psychologist. I think he's the only psychologist to win the Nobel Prize who's in economics who wasn't in that field. So what is he doing? He's studying human behavior relative to the models. Do people actually act the way the economists and finance people say we act? So he won the Nobel Prize. You can go out and watch his Nobel Prize lecture. There's like 20 people in the room. There's several typos in his presentation, unfortunately. But it's really, really cool stuff, really interesting stuff. They actually go out and test people based on the theories. There's some really key findings that he has that I think are really critical to understand in finance. How many have read Thinking Fast and Slow? Yeah. Did you like it? Was it?
I like how it's pretty good.
So Annie Duke is essentially the same book, but much more practical. He's kind of theoretical and tests and scientific. He's like, what do you do with this stuff? Which is why I really like it. So here's his Nobel Prize speech. If it still works, I test these every semester, and then sometimes they just go away. See if it's still there. It's still there. And this is his, it's called prospect theory. That's his big theory. I've probably heard bounded rationality. We don't make optimal decisions. We make decisions based on the time and the energy we have and information we have. But I want y'all to actually watch some of these things, and I'll let you know this weekend what to watch. But
I just thought, I'm waiting one, and they love.
so
And
he has some. You have to be careful. He does mention that the slides are wrong when he has this putting around the slides, so it's a little frustrating looking at it. But really great lecture. Here's a talk. I think this one may be the one that's on prospect theory itself. I don't know if y'all know Google has these Google Talks. Here he's talking about thinking faster. He's talking about the book itself.
All right, I'm John Boyd. It is my great pleasure. People are very good thinking about agents. The mind.
So if you don't want to read Thinking Fast and Slow, if you watch the 3 videos here, you essentially get the entire book. So great lecture, and then my favorite of all. You need to watch this just to make your life better. I've had it my whole life based on this, and I didn't even see his. I didn't even see his lecture. So this is his lecture on happiness and memory. Have any of y'all watched this before? It will change how you do vacations. It will change how you live your life. Yeah, it's really good stuff. It's only 20 minutes, but I highly recommend it. So we'll get into what he means on this. Just real quickly on this one. He says, well, think about a vacation. Why do you go on vacation? Well, you say it's for the experience, but he says that's absolutely false. Why do you go on vacation? For the memory of the experience. That's the only reason you go. You don't go for the experience, you go to create. That's the purpose of a vacation, is to create memories. That's what he says life is all about, creating memories. How do you create memories? And he gets into that. How does the mind remember? I read an interesting book. I don't know if I can find it. I don't know if I recommend it, but it's really interesting. We will talk about it. This book on being certain. He talks about memory and how bad our memories are. Because you go on a vacation and create a memory of an experience, but our memories of our experiences are really flawed. He has an interesting example. I mean, the best example is a professor right after the Challenger disaster. He had his students write about what they were thinking, where they were. He collected it. Like 2 years later, he went back to them and had them rewrite what they did. And several of them had it completely wrong. But they were absolutely sure 2 years later exactly what happened. But what they wrote the day after was very different. What he thought was interesting is some of the ones that their memory is completely different. They thought what they wrote 2 years later was more accurate than what they wrote the day after. That's how certain they were in their mind. And he talks about why does the mind get so certain about something that we're really pretty clueless about. And so he's going to talk, Taleb and here, you may not realize it as a finance person, but your memories have a huge impact on your decision making, that our memories are incredibly flawed. And he talks about that in this. So we'll talk about Kahneman here. And I do want you to watch a couple of their videos. I would watch all three of them over you. All right, let's stop it there, but we'll get into it. I really love this part of the